Good morning, everyone. We're coming to you on Tuesday, May the 2nd. And this day is pretty radical today. We've got a lot of volatility going on because we got some more banking crises in the mix. Now, we have a lot of other banks that are coming up to be looked at. We have City National Bank, First Republic Bank, East West Bank, Commercial Bank, Western Alliance Bank, Frost Bank. We have a lot of regional banks that need to be looked at, and Western Alliance Bank looks like it's pretty close to going under as well. Reading through an article this morning from the Executive Education Facility Spotlights from Stanford Business. In that article, it talks about how the U.S. banking system, the market value, its assets is $2 trillion, and it's lower than what their book value assets account for loan portfolios held to maturity. Basically, what that means is that the banks are kind of upside down, and in their layout of liabilities and assets, these things are flipping, which is causing the banks to start to roll over or begin to become unstable. Now, there's a lot of contributing factors to this, as how they look at mortgage-backed securities. Obviously, the Fed raising rates, all these things are contributing factors. Not having a good risk management department. You need to understand that for years, we have been able, markets, banks, everyone has been able to plan out investment pretty easily because the Fed has kept rates artificially low for over a decade. And so the play was really always the same. If there was a pullback in markets because of Fed policy, because of low interest rates, this would facilitate lending. Well, the Fed's not doing that anymore. And because of that, we are getting to the point where this mindset that's been going on for the last decade of low rates means pullback means more liquidity because more lending, that is starting to go away. And banks are not lending as we looked at last week. Banks are actually, their lending's contracting. And when we have contraction in lending, that means liquidity begins to go away. And when liquidity begins to go away, because liquidity is key for markets, we get lockup. And when we get lockup, we get risk off. Risk off. So we're going to be looking at some risk off things that could be coming online. Now, obviously, I'm still of the opinion that we go a little higher before all this kicks in, but we're in May now. And my projections were in May, sometime in May, we would begin to see the unwinding of all of this starting to happen. Now, I told you when these bank crises began that was just the start. We haven't even begun yet. Now I'm going to show you this chart here, this regional banks, it's ETF, it's by Spiders, and what we're looking at here is a channel line. And if we pull this back, and I've been watching this for quite some time, but we have a channel line here. We had a head and shoulders up here, it kind of broke above channel, came back into channel, which is a very bearish signal. And then we had this other channel right here, the yellow channel, before we're speaking specifically of the green channel, but this yellow channel broke. And that was the indication that this thing was going to start to head to the downside to this channel support line down here. Now, what is my expectations of this? Well, if I drew this out and showed you what I was looking at, it'd be something like this. We get some sort of a bounce, which would mean that we would be looking at some sort of a relief plan, but the relief plan would not hold in place, and we would break through this channel. I expect to break through this channel. I have been talking about the contraction of lending coming on board for the last 2 years when we were in this big parabolic move to the upside, and it looked like we had tons of liquidities as programs begin to go away in a fiscal policy, and as lending programs begin to go away, we had a contraction then. And when you liquefy through fiscal policy and then you take it all away and then you raise rates on top of that, that is disaster. That is absolutely no soft landing, but mega hard crash, no survivor landing. And that's what we're going to get, folks. That's what's coming our way. And this, if it bounces at this channel, it's going to turn right around and head on through and break. If it bounces, if this bounces, because this is going to become a contagion. And contagions, they spread rapidly. If you didn't live through the pandemic, which if you're listening to this, I hope you did, because there's some really issues there. But if you lived through the pandemic, you saw once it became a contagion, everything stopped in a heartbeat, really quick, fast, without warning. That is how this financial crisis is going to happen. We have been looking at these negative yield curvatures in the euro dollar, in the bonds for the last year and a half, and it's just looked awful. And they are an indication. When you get this much of a negative yield curvature, it is definitely an indication. And I'm not going to say here and beat around the bush. It is an indication we are going to go into a recession. And in this case, if we begin to continue to unwind these banks, and with what we've done and the contraction in easy money, I'm going to say it's going to go into a depression. I'm saying I think it's going to go into a depression. And when you go into a depression, as we talked about last time, you're not talking about the price. You're talking about people losing jobs. And when you lose jobs versus the value of your money, it is a much worse scenario. But we've lost the value of our buying ability because of cost push inflation, and now we're going to start to lose the jobs. And when we start to lose the jobs, that's when everything begins to get the contagion begins to spread, and everything at once starts to contract overnight. This is kind of what I'm looking at. This is the beginnings of it. Market, we have this week the Fed coming out, interest rates, expectations, raise another 25 basis points. I don't know what they're smoking in there, but they're smoking something, because if they can't see the writing on the wall here, either this is a planned thing or they're just plain downright stupid. So if they do raise 25 basis points, I would say it's the last raise you're going to see, because if they do that, it's going to add more. It's like throwing fuel on the fire. And it's going to cause things to break down even more rapidly. If businesses can't get loans to continue to operate and to function, they will lay off. They will contract in growth. You cannot build business without lending. You just cannot do it. You can't even operate our monetary system without lending. The dollar system is based on lending. It's based on debt. And if that dries up, you have no liquidity. Now, I know there's a lot of people out there that says the BRICS are out there, they're forming, they're exchanging with each other. Well, no. This is a precept that they're going to do this. They haven't actually put a plan into place to do this yet. This is a big thing. It takes a long time to do. They've been talking about this since 2009. It's a lot of work to put this into place. It's a lot of work to determine who's going to be the people who's going to govern this, who are going to manage it. Which country is it going to be? There's a lot to be done with this. So until that happens, we are still on the dollar system. I'm not talking about the domestic dollar system. I'm talking about the euro dollar system. We are still exchanging and doing things final. When it comes to the final exchange, it's still done in dollars. The big percentage of it. So we're not going to bring that in here right now. But we are going to look and see where risk stands today. So here's our risk charts. We see that the S&P has come up, hit this level again. It's pulled back. We were looking at something like coming up to this level and then rolling over. We really are in the echelon of very high levels of the bear market rally. And I was looking for maybe a little bit more out of this. I'm not going to sit here and say we're going to get it this week. I'm going to be very reserved about that. Probably the only way we would get it is if the Fed came out and say we're holding rates and this is it. We're not going to raise anymore. We could see markets have a brief jump and hit our targets, but I'm not going to guarantee that or say that's going to happen. Like S&P come up here, hit this, and then swing right back down. I'm not going to say that. Dollar is holding this support zone. Again, we were looking for a break further down into here, into the 98 region. We'll see if we still get that. Right now, there's no indication of breaking this support level, setting here at 179, 180 level. Once it breaks that and holds below it, then I think this lower target is in place. That is still there. I'm not going to say that we're going to head back up from here yet. If we break this high over here, which stands at about 105.88, I'm going to cut my last trade in the dollar short, and I'm going to look at getting long dollars. Over here in the VIX, we see we've come right down to our channel line. We held there. We didn't break through. I thought maybe we'd swing down just a little bit lower, then start to head back up. But we are actually starting to head up now. I told you the scenario that is a pretext before the major bear market comes in. That is, volatility would be going up and stocks would be going up at the same time. We'll see if that plays out. We have today specifically the 10-year yield starting to roll back over. It pushed up and then it rolled back over. It came up to this level, went down, pushed up. We thought it would go up a little higher, up to about 3.66. It has not done that. Today's contagion has really slammed the 10-year, and gold has climbed today. So we're going to see how that works out, because generally you have a liquidation of gold before a bear market. Now, we are not in the bear market I'm talking about yet. I'm talking about when we go into the large, we're going to lose 50% bear market. We have not hit that level yet. So we could have a lot of ranging, a lot of whipsawing in these levels right now until we hit that move. And so this, the 10-year could still come up here and hit this. Obviously, that would require the Fed to come out and make some sort of a gesture that they're going to add liquidity by lowering rates or holding rates, or backing off, something that gives confidence to the market where the liquidity would start to come in, and we could see this head back up a little bit on the 10-year, and volatility kind of stay stationary here. But we are up at resistance here on vol at about 19.86. We're going to see if that holds, and we're going to look at the NASDAQ next. Last week we talked about how earnings were coming out and how we felt like those earnings would come out better than expected. They did come out better than expected, but in the tech stocks, but they, on the other side of those earnings, there was a lot of not good information. But nonetheless, the markets rallied as we thought they would, and they did rally, and they went up to the resistance zone again. And today, because of this contagion, they're pulling back. I expect them to pull back a little bit more, but possibly tomorrow there could be a change in sentiment as the Fed comes out with its policy going forward. Even if it does do an interest rate, I believe that policy moving forward is going to be the catalyst that creates the last movement up to this level in the NASDAQ, which is about 13.7, which we've been talking about. I am at that level, if that does take place, going to be out of any longs on this and stay neutral to see what the outcome is. But as of right now, we are still in this big range. We have not broken this level. It's held. It's a pretty strong level here at 13.37, and it's going to have to break that in order to move up to this level. If it doesn't do that and it breaks below this level here, especially this low setting at about 12.8, this thing is going to come down, retest, and it's over, folks. So we'll see how this rolls. But again, look for choppy conditions this week until we hit a breakout. And then once it breaks out, I believe it's a fake, and we roll back over. I just don't see anything that's going to bring liquidity into this system that's going to continue to move up higher and higher. I just don't see it. If it does appear before, or during this process, somewhere liquidity comes in, okay, so be it. Then we get the liquidity and we push out. I just don't see it yet. We still have this double bottom down here that we need to complete. So if you look at this area down here, this is the double bottom. That's one bottom there, and this is the second right here. We've done a move back, we've done a pullback, and this pullback is going to complete at about that area, which stands as resistance over here. This total resistance up here sets at about 14,000. We're going to get close to that resistance level, and I'm going to see what it does there, but I'm expecting it holds that resistance, and then we roll back over and we complete this swing down. And that's going to total from high to low, is going to complete a 50% move in the market, or a little bit more depending on how aggressive this gets. But we could see even further than that in the next few months. Again, if things work out the way I think, it will be more aggressive than that. We were not a participant in this long. It did complete what we had laid out for a long. If you did hold this position, congratulations. I did not. Since I had S&P and NASDAQ on, all three, didn't want to be involved in all three, especially when we started to get a lot of range down in here. So we leveled off risk on this. We didn't take it, but it did hit to T. Now we're back at this resistant level. The only way we're going to see this go higher is if we break this resistant level and heads on up. But I do only expect it to get in the 35,000 range on the Dow. But past that, no, I don't really have expectations to move past that. Gold had a bar up today for obvious reasons because of this contagion. We're going to see if this bar holds, and it's in this wedge right now, and we believe because of what's coming, gold's going to liquidate out, meaning it's going to drop again. And so we have been neutral in this. We got stopped out of our last long position. So we've been neutral in this. And really what I'm looking for when the liquidation starts to occur, I'm looking for gold at some point to start to head down. And once it heads down, then to look at it really hitting new highs, heading up. That has not happened yet. We're in this very nasty range here. As I like to stay neutral in these ranges because they can get pretty nasty, as you see there. So we stayed out of that. Still neutral on gold. I am still looking for this. So a break of this bottom range, a break and a hole below it, is going to be an indication that I'll start looking for a short in gold. That's what I'm going to be looking at, a short in gold as we look for that liquidation. You'll get a decoupling of the correlation of 10-year rates with this, but they eventually come right back online, because when the Fed starts lowering rates, and that's when the 10-year really starts to fall, that is when things are really bad, when they have to do that in these particular circumstances. And then that's when gold's really going to start to fly after the liquidation process. Then people will be buying gold for more secure purposes. Our oil trade is doing very well. We've taken some profits off of it, but what we have on still is doing very well. It continues to move to the downside. I have target on this. Well, it's lower, but obviously we could take it off at trend line, channel line. I'm sorry. We could take it off there, which is probably what I'm going to do. But oil, as far as an indicator for deflation, it's a good one. And it is telling us that something nasty is coming. And so oil is falling in our trade, doing quite well. So going to continue to hold the remaining positions on oil where they're at. I've got my stop at a little bit in profit now. It was at break even. It's now in profit. So just going to let it go, folks, and not do anything with it. Pound yen, I am out of that. That was a good trade. Moved the stop way up. We are now out of that and in profit, and we're finished with this trade. So not going to do anything with it. Hit this resistant level up here at 172. Was a good trade. Went very well. So that's pretty much it for that. Finish with that. It compensates for the dollar yen. So nothing on the pound yen right now. Pound Aussie, I am possibly looking for a trade as a pullback here. We have on the weekly this candle. It's looking like it could close as an inside candle. If this closes in an inside candle, I'm going to get short Pound Aussie. Now, where would I get short to? Well, it's going to be a fib pullback. So I draw my fib here. If this is the top, and I'm going to short this down to this level right about here. It's going to be about 1.813 is where I'm going to look to go short. So if I drew that out here, it would be something like this, and we would come down to about right there. That is about as far as I will take this. That's a pretty good trade. We measure that move. If we enter in somewhere right in here, it gives us a move about 600 pips. That's a pretty good trade there. I will take that with 3 positions in this trade, as it is a pullback and we're going against trend. So I don't want to load up 5 positions on this. Going back down here onto the dailies, what we would definitely be looking for, sorry, that's the 4-hour. Let's get to the daily. What we'd be looking for is right now we'd be looking for somewhat of a pullback. This channel, if you can see it there, I'll draw it out just in case you can't see it. We're looking at this channel right here. What we would look for in this smaller region is of the daily is an up, and then a rollover and a break. Now, since everything to me indicates this is going to roll over, when this does a pullback, I'm going to get short at this level. And I'm looking at probably, let's see, we'll make sure we get this just right here. We'll do a move like that. I'm going to say that is about, I'm going to get short about 1.87709 in there. Let me go ahead and put this up to a short position, and this is what we're looking for. So that's what we're going to be looking for there. We could go all the way back up to 1.893 before we roll over. So be aware of that. Being that that is the case here, I will probably scale into this. So I'll put 2 positions on here and say my final position, if it goes up to the set 0.78 fib, and get in at 1.893 on the 3rd position. And then if we get stopped out, we get stopped out, so be it. But that's the trade right there. Euro Aussie, I'm going to look to go short in this. Now I'm going to lay into this a little bit differently. So I'm going to put on a single position at this level. If we do pull back to a higher level, say near the 1.66 area, I'm going to put in 2 positions there. This one has a little bit lower risk reward ratio, so I don't want to load up on it right here, but I will do a single and do a double if it pulls back further. If it breaks and holds, I'll load up 2 others on the pullback of the break and hold. So that means it breaks, holds, pulls back to the channel. That's where I'll add the other 2, and then down to target, which sets at about 1.60735 is where we're going to take this one to on a counter trade. Bitcoin, I continue to stay neutral in. There is nothing here that tells me to go long or short. Obviously, if we break this high here and hold above it, I'm going to take the swing, what's left of it, higher up to whatever that is when it gets there. But so far, this has not shown me anything to get me involved in it. We are right now in this range, as you see over here. This was a pretty choppy range. We're getting the same thing here. We did take the breakout on Bitcoin up to that level. Did very well on this and have done well on this year. Fingers crossed. But as far as where it's at right now, it looks like, if I had to give my opinion, it just looks like we're going into a wedge to break in one direction or the other. Whether that's a higher high or a lower low, I don't know. But we're holding it. A break of the wedge on either side will give an indication to go long or short. So if we break and hold on the long side, on the pullback, we're going to go long. If we break and hold on the low side or the short side, we're going to go short on pullback. And that's the way we'll play this. But right now, it's not giving us any indication of what it's going to do. So we'll stay neutral in this. Aussie yen, I've been looking at this for a trade. It has not materialized yet. I thought we would get an opportunity today of a break and a close above channel, but it did not do that. So I'm going to stay neutral on this, but I am looking at this. This is wedging up, and I believe there's a possibility we could break to the top side on this. So I'm looking for that possibility to materialize. So far, it has not done that. So I'm going to stay neutral on this, but do have this on the radar. In the dollar pairs, I don't see anything that I want to get involved in right now, or anything that's really setting up to be a trade. I do see maybe a couple things starting to come into play, but as of right now, I'm going to stay neutral in the dollar pairs, but eventually we're going to be short these again. We're going to be short euro dollar, pound dollar, Aussie dollar. We're going to be short those, so keep an eye out for my videos. We'll follow up on these when they start to turn and get involved in, because they're going to have some nice moves. But as far as anything else going on this week, obviously the war is not going well, and NATO's not happy with Ukraine. The U.S. is pulling back support from Ukraine. Russia is starting to show its air superiority and dominance with their strategically high-value targets that they're hitting with their hypersonic missiles and with other conventional missiles. It looks like this thing's going to wrap up, and Russia's going to be the winner, and NATO's going to be the loser, or the United States once again. A CIA war. So take it for what it is, but this now emboldens Russia. Also, through this war, we have pushed Russia and China together to form an alliance that is now on the world stage. That will be something that will become prominent in the years to come. Watch for this, because it will be a very big thing. Meaning, yes, I believe that we will get into the war with China and the Soviet Union, and they will come on to American soil, and this war will be fought here on American soil, no doubt in my mind. But this is the beginnings of something that's going to happen years down the line. So just right here, when it happens 10 to 20 years from now, this is where I told you is going to happen. You can prepare for it now, but pretty much that's the way it's going to go as American society continues to deteriorate under very poor leadership. So take that for what it's worth. But other than that, watch for the Fed on Wednesday, the big news of the week. Then we got NFP on Friday. Let's see how it all pans out towards the end of the week. But I think that we're going to, on this jobs report, it's coming in from April, we may see a little job loss, but I'm looking at June as the big one. So we may see a little bit of that in this one. So we'll see how it goes. But June is the big one I'm looking at for NFPs. That's it for this week. Those are our trades. That's what we're looking at to get involved in. Wish you the best of luck in your trading. Have a great week.